you very much.
Thanks, Mr. Chair. I didn't know that I have only 20 minutes for this presentation. I prepared for 29 minutes. Right, so I'll have to, cut off some of the stuff I have here. As the title indicates, we are looking at stock exchange demutualization. And the question that we are trying to explore here is whether the demutualization of stock exchanges, does improve the quality of the market. For those of you who are not familiar with what is going on in the stock exchange industry, let me give you just a brief introduction to the developments that have taken place in the exchange industry. Let's say 20 years ago, most of the stock exchanges were organized as mutual entities. They were owned by, they were cooperatives, basically. And as you know, cooperatives serve the interest of the members. So stock exchanges were organized like that. They serve the interest of the members who were the basically investment banks. But because of increased competition, beginning 1993, with the Stockholm Stock Exchange taking the first step in this whole movement, a number of companies or stock exchanges have followed them. They have demutualized. And basically by demutualizing, they change the governance system. They change the business model. They become profit maximizers. And they become like any other business. The sole objective is to make profit. Some of the exchanges have taken a further step to demutualization. Basically what they do is they undertake IPOs, initial public offerings. They issue shares to the general public, and they list the shares on the same exchange that they are managing. A number of the major stock exchanges, from New York to London to Toronto to Sydney to Hong Kong, Singapore, Japan, they've undertaken this demutualization step. So some of them it started from demutualization, or mutualization to demutualization to self-listing. And the self-listing is basically listing their own shares on the exchange that they themselves are managing, the stock exchange. So London Stock Exchange, as a company, is listed on the London stock market. So is Toronto Stock Exchange. So is Hong Kong Stock Exchange, New York Stock Exchange, all the major exchanges. The demutualization and the initial public offering gives them a currency or an instrument, or a currency to undertake mergers and acquisitions, because sometimes they can use their own shares as a currency to undertake mergers and acquisitions. Here are some of the competitive forces that have led to this development in the stock exchange industry: technological advancement, globalization, integration, liberalization, and so on and so forth. Now, as I said, beginning with the Stockholm Stock Exchange that first demutualized in 1993, a number of stock exchanges have followed suit. And here are some of the benefits that these demutualized stock exchange can realize. By demutualizing and converting their governance structure from cooperative to for-profit entities, the demutualization allows these firms to tap into new sources of financing for expansion and for technological investment. When these entities are mutual entities and they need to expand, the members will have to contribute money. But sometimes the members are not willing to do that. So the mutual structure sort of constrains the ability or the capacity of the exchange to raise capital to invest in some of these things. So here are some of the benefits. But let me now talk about the motivation for the study and why we focus on market quality. Now, when these exchanges demutualize, their objective changes significantly from just serving the interests of the members to profit maximization, and also to not just profit maximization, but maximization of value for the members of the exchange. So we are arguing here that the change in the business model and the fact that these exchanges have to account, the managers of these exchanges have to create value for the members, will motivate them to do whatever they can to attract business. Because after all, at the end of the day, they have to make profit. And how do exchanges make profit? right? They have to attract order flow to the market, and as the order flow increases and trading volume increases, these exchanges will be making money, will be making profit, and the owners will be able to enjoy, the investment, or they'll benefit a lot from the investment that they have made in these entities. So basically, what we are arguing here is that the changes in the business model and the quest for profit maximization, or the quest to maximize profit, will compel the managers of these entities to put in place measures that will help them increase order flow. Lee and Malinova and Park in 2015 observed that demutualized stock exchanges have introduced incentive schemes for traders to post attractively priced limit orders as a strategy to competing for trading volume. So we are arguing that the desire to do this will lead to increase in order flow, trading volume will increase, liquidity will improve, and as a result, there will be a reduction in the bid-ask spread and volatility. And we're going to use bid-ask spread as a measure of market quality. Now, despite the fact that a lot of the major stock exchanges have undertaken demutualization and initial public offering and have self-listed their shares on their own exchanges, not much has been done to look at the impact of this demutualization on this important aspect of the market, with the market quality. There has been studies that look at the performance of demutualized exchanges. Researchers have looked at operating performance, they've looked at stock market performance, they looked at how these exchanges perform at the time of the initial public offering, and so on and so forth. But we are, I would say, one of the first to look into the effect of demutualization and self-listing on market quality. And market quality is important to every stock exchange, because if the market is not, the quality of the market is not there, the exchange will not be able to perform its key functions. So some of the questions we explore in this paper is, does demutualization have an impact on market quality in a multi-country setting? And because some of the exchanges, stock exchanges that have demutualized, have taken the next step in becoming publicly traded entities, and they have to disclose a lot of information, analysts will have to monitor the performance of the firms. We are asking whether there will be incremental improvement in market quality for those exchanges that take the next step to list their shares or become publicly traded entities and list their shares on the stock market. So a related question we are asking here is, are there incremental improvement in market quality for those exchanges that undertake initial public offerings and list their shares on the exchange that they are managing? Now, in the interest of time, Mr. Chair, I will skip most of the prior studies that have been done on this interesting phenomenon. But let me talk about our hypothesis, why we expect the market quality of these exchanges to be affected by the demutualization. I've already talked about the first one. The desire to make profit will motivate the exchanges to put in place strategies and measures that will help them attract order flow. Because as order flow increases, as I said a while ago, liquidity will improve, bid-ask spread will reduce, and that will be good for the firms that are also listed on the exchange, because if the bid-ask spread reduces, the cost of capital will also reduce as a result. A motive, or one motive for demutualizing, is to improve the governance and performance of the exchange. And Mendiola and O'Hara from Cornell have done studies on this that show that demutualized exchanges improve their governance structure significantly. The performance of the demutualized exchanges also improves significantly. Now, transparency, when the governance of these exchanges improve, or Mendiola and and O'Hara and Chang and others show that demutualized exchanges are more transparent, especially the ones that undertake initial public offering because of the disclosure of information that they have to carry out. So the transparency could boost the confidence of issuers and investors, and this can help also attract firms to list on these more transparent stock exchanges. Research has also shown that demutualization allows these exchanges to issue more shares and raise capital to invest in technology and automation. And researchers have shown that investment in technology and automation also does have effect on market quality. Why? Because improvement in technology can reduce the speed of execution, and it can lower trading costs. And all these will help reduce bid-ask spread. And this will also help attract more firms to list on the exchange and also traders to trade on the exchange. And in the end, the market or the quality of the market will improve. So this leads us to hypothesize that the measures of market quality for a demutualized exchange will be better than those that are still mutual and run as cooperatives. And not only that, we expect these measures for the demutualized exchanges to be better in the post-demutualized phase. The other hypothesis, key hypothesis that we examine in this paper is the fact, or relate to those exchanges the demutualized exchanges that also become publicly traded exchanges. They become companies. They corporatize their structure, issue shares to the general public. So some of us can become and have become shareholders in Toronto Stock Exchange, New York Stock Exchange, London Stock Exchange. 20 years ago, that wasn't possible. But now, these stock exchanges are publicly traded companies. So we are trying to see whether the additional disclosure and the transparency that follows the public listing will, and the fact that these exchanges will have to account, they have to show to their shareholders. So now we are dealing with shareholders, not members. Firms will have to account to their shareholders that the capital that have been invested in these entities are being used in a value-enhancing manner. We are arguing that because of all these pressures to not just make profit, but to make value or to create value, to enhance the value of the investors. The fact that analysts will be monitoring the performance of these publicly traded entities, the fact that these publicly traded stock exchanges will have to disclose a lot of information, all these factors will make these managers more aggressive in attracting business. And what that will mean is that whatever strategies they have to put in place to attract order flow will be put in place. So we are hypothesizing that the market quality measures, and I'll talk about these measures shortly, for publicly traded demutualized exchanges will be better than those for the demutualized but not publicly traded stock exchanges. Just in case I run out of time, here are a summary of the key results. We find that the effective spreads for the demutualized exchanges in the post-demutualization period reduces significantly. And the reduction in transaction cost is symmetrically distributed. We realize that the gains to the demutualized entities in the developed world are more than the gains in the spread or reduction in spread that were experienced by demutualized exchanges in the developing world. The listed firms on the demutualized and publicly traded exchanges experience additional improvement in spreads when the exchange becomes a publicly traded entity. So in the few minutes that I have, let me talk about the sample We have 30 stock exchange mutualizations that we examined here. We had a control sample of 11 mutual exchanges. What we did was that for every exchange, we of course couldn't include all the firms, so we focused on 15% of the firms that are listed on the exchange, 5% in the top tercile in terms of capital market, 5% in the middle tercile, and 5% in the bottom tercile. We selected these firms and we examined their bid-ask spreads and over the pre and post demutualization phase. The stock exchange level data included the number of listed firms, market capitalization, and so on and so forth. We obtained them from the World Federation of Exchange website. These are the measures of market quality that we used. These are standard measures that have been used in the literature. Multivariate regression analysis was based on this model, and we used the two-stage least square technique to do the examination. Just to give you a graphical presentation of our results, this shows the trend in the spreads after the demutualization that occurred. So the effective spread for the demutualized entities, as we see, dropped over time. Here is the industry adjusted effective spread. This is for mutual entities. Those entities that still maintain the cooperative structure. We observed that these firms did not experience a significant drop in spreads. Rather, the mutuals experienced an increase in spreads. And the reason, or our explanation here, is that this is a zero-sum game, right? So if the developed countries the developed markets that have demutualized are attracting order flow, right? And this is a zero-sum game. Someone has to lose because someone's gain is another person's loss. So the demutualized exchanges are benefiting significantly from a reduction from an increase in order flow, and therefore a reduction in bid-ask spreads. We see the opposite in the mutual or for the mutual exchanges. Now, here are some of our key results. First of all, we looked at the before and after measures of spread or market quality. So the first panel here we look at the demutualized entities. Here is for the mutual, and these are the differences between them. What we see here is that for the demutualized, we have the mean measures and the median measures. They give us similar results. The post spreads, the post-period spreads are much lower, statistically different from the pre-spreads. Similarly, our multivariate regression analysis, sort of confirms the result that we got from the univariate analysis. By the way, I think this is here we're comparing the developed and the developing markets. The demutualized exchanges in the developed market experienced a significant reduction in spreads than those in the developing countries. Now, this table shows the multivariate regression analysis. Our key variable of interest here is the demutualized times the post-dummy, and consistent with the univariate result, we see that the coefficient is statistically significant at the 1% level, suggesting that in the post-demutualization period, these firms experience a significant reduction in spread. We try to identify the potential channel through which these reductions in spreads come about. And what we found was that an increase in investment in technology, increase in the number of firms that are listed on these exchanges, an increase in market share account for the significant drop in the spreads that we identified earlier on. Our second hypothesis zeroed in on the exchanges that took the next step in becoming publicly traded entities. we try to examine whether there is an incremental benefit for going public and listing the shares on the stock exchange as far as the improvement in the market quality indicators is concerned. And what we find here, this is our key variable of interest. The IPO dummy times the post-IPO period, we observe a significant drop in spread. And this is in addition to the improvement in spreads that arises from the demutualization. So consistent with prior studies that document an improvement in operating performance as the exchange moves from mutual to demutualized to IPO in the continuum, we observe a significant drop in market in spreads as the exchanges move from mutual to demutualized structure to a publicly traded self-listing structure. So there is an incremental improvement in market quality, and here we are using spread as our proxy for market quality. There's a significant improvement, incremental improvement in market quality when the exchange becomes publicly traded. We carry out, just wrapping up now, we carry out quite a significant number of robustness tests. I'm going to talk about one of them because one of the referees asked us to do this. The referee said that in order to ensure that, or to satisfy the reader that our results are not due to chance, we should do a placebo test. So we did a placebo test. We picked a date, a random date. He or she said, pick a random date, repeat your analysis, and let's see what will come out of, what your key, variable of interest will tell us. So we did a placebo test. We used January 3rd, 2004 as a date. And this date happens to be almost halfway through our study period. So we picked this, and we assumed that all the demutualizations occurred on that date. And we repeated our analysis. And we do not observe any reductions in spread in the post-demutualization period. Basically, the referee's message was that if we do this test, and we realize that our post-demutualization dummy, is negative and significant, then our results we can't attribute that to, demutualization. So we did a test, and we realized that for the placebo test, the post-demutualization dummy wasn't negative and significant. In fact, it was positive but insignificant in most of the regressions that we ran. So to conclude, we examined this interesting phenomenon that has taken place in the stock exchange industry. A number of the major stock exchanges have demutualized and have gone public. And prior studies have examined the impact of this changing governance structure on performance, on underpricing, on a number of key variables. We contribute to this line of research by examining the effect of demutualization on market quality. And we use spreads, bidder spreads, as a proxy or as a measure of market quality. And what we find is that the demutualized exchanges have experienced a significant reduction in spreads. Well, let me put it this way. Firms that are listed on demutualized exchanges experience significant reduction in spreads. And that is good for the firms, it's good for the traders, it's good for, the firms. If they want to go back to the market and issue more shares to raise capital to finance their projects, a reduction in bidder spreads, according to the literature, is good because the cost of raising capital reduces as a result. Mutual exchanges have not experienced, have actually experienced increases in spreads. Going public, taking the next step and going public following demutualization generates incremental improvement in market quality. We realize that technology investment, increase in market share, and increase in the number of firms that are listed on the stock exchange contributes to the reduction in spreads that we documented in this study. Now, our results can have implications for a number of exchanges in not just the developed world, but in the developing world as well. Our study included a few exchanges from Africa. Johannesburg Stock Exchange is actually a demutualized exchange, not just demutualized exchange. It's a publicly traded exchange. It's listed on the Johannesburg stock market. The Cairo Stock Exchange is demutualized. Kenya is talking about demutualization. Ghana is talking about demutualization. The Nigerian Stock Exchange is talking about that as well. So Morocco is also contemplating demutualization. So the results of our study do have implications for these markets, these exchanges that are contemplating demutualizing. Okay, I'll stop here, and I look forward to receiving comments from the chair and from the floor. Thank you.
Yes, thank you very much for this very interesting presentation, also for trying to fit it into our 20-minute limit here. The paper is very rich, I think, and I would only encourage anyone interested in the topic to read it and spend more than 20 minutes reading it, ideally. So do we have questions from the audience? Okay, so there are already 4. Let's start at the back, perhaps.
Yeah, thank you, Isaac. My question relates to one of your results, which is that the benefits of demutualization is greater in developed countries compared with the emerging market. Why do you think we observe that? And what can those developing countries do to enhance the benefits from demutualization? Thank you.
Hi Isaac, my name's Peter O'Flynn. I'm from the Institute of Development Studies. I was really interested by one of your graphs, which was on the trends, which was looking at prior to demutualization, the moments of demutualization, and afterwards on the trends. And one of the things that I saw was a blip upwards right at the moment of the
for demutualization,
yeah,
or for mutual.
For demutualization, it was the top left corner, and I was just trying to understand the interpretation behind that when bond spreads were reducing prior to that moment. Thank you.
Thanks, Isaac. You managed to get a huge amount into a short time. Can I just try 2 quick questions? I could not understand your argument that world trading was a zero-sum game. I thought the whole point of reducing spreads was to attract more firms into the public market and increase volume for everybody. That's just a small point. What I was more concerned about was your criteria for market quality, which relied entirely on price measures. And we know, and we've had a quote stuffing case a couple of weeks ago, we know that price measures can be easily manipulated. And I would have liked to see much more emphasis on issues like externalities in corporate governance of the firms that are actually quoted. Because one of the things we've seen with stock markets becoming more publicly quoted themselves is like kind of a race to the bottom in terms of being willing to attract more and more dual listing shares. So I wonder if you could comment on some of those. Thank you.
So 3 minutes to answer the questions. You can choose which ones you would like to answer.
Okay, how many minutes? 2? Okay, I'll try and see if I can answer all of them with 2 minutes. Why there is asymmetric distribution of the benefits, in the sense that the developed demutualized markets enjoy or exhibit most of the, or a significant portion of the reduction, the benefit that we observe here. We attribute this to competition. Right, the competition amongst stock markets in the developed world is keener, is stronger than that in the developing countries. In some of the developing countries, there's only one, although these days competition is not localized. Competition is globalized. So you may be, South Africa, the CEO of South Africa stock market. Don't think that because there's only one, you are not a monopoly in this day and age. You are competing with, for order flow, right? So, but we attribute that to competition because it's keen here in the developed world, the desire to do things that will help you beat your competitors is much stronger. And that's our interpretation. That's the explanation we gave in the paper. The blip, I think, I hope you are not the referee who reviewed this paper because the referee, asks us to comment on that or explain why, before demutualization, the demutualized exchange, I hope that's your question, the demutualized exchange seemed to have experienced significant appreciation in spread. Yeah, a blip. We struggled with this, but we attribute this to competition from ECNs, dark pools, ECNs, electronic communication networks, because these are, players that actually brought competition to the doorstep of the brick and mortar stock exchanges, right? So, and we are arguing that this is actually one of the reasons why these exchanges decided to demutualize, so that they can sort of have the freedom and without any constraint from the members to do what they have to do to meet the competition that is coming to them. And the ECNs, according to Mandela, O'Hara, the ECNs have played a significant role in this movement that has taken place in the stock exchange industry. So prior to the firms demutualizing, we observed a significant increase in bid-ask spreads, right? And then they demutualized, they free themselves from the tentacle, so to speak, of the owners, and then raise capital, invest in technology, and they are able to sort of undertake these activities that lead to a reduction in spreads. Chris, your question about zero-sum game, why we think that this is a zero-sum game. We think that if you take the global stock market as a unit, and we are competing for order flow, there's so much, there's so many firms that we have. Let's assume there are 10 million firms listed on the global stock market. And if you are able to draw half of them, the demutualized exchanges are able to draw 75% of these firms to your markets or even trade. If you're able to attract traders to trade on your market and they move away from my market, then what we are arguing is that your gain is our loss. So our explanation of this zero-sum game relates to the fact that, globally, the volume of trade, is limited. So if you are able to attract or draw trade from the mutual exchanges, then basically we are losing. Those of us who have been demutualized may be losing trade to you because of the fact that you've been able to do all these things to attract. So that's where we are coming from with this argument of zero-sum game. I'm not sure whether this is convincing. I've convinced you enough, but that's the point we are making in this paper. Price measures. Yes, we decided there are other aspects of market quality, but we decided to focus on the cost measures. That's why we focus on bid-ask spread instead of, other aspects of market quality.
Good. Well, thank you very much again for a great presentation, great paper.